Welcome to XRP Pro Ledger, and today we are sitting at the intersection of two of the most consequential developments in both the crypto market and global geopolitics simultaneously, and the way they resolve in the next 72 hours is going to determine whether the crypto market goes parabolic or experiences one of the sharpest corrections of the year. The North Carolina Bankers Association has just launched a coordinated sabotage campaign against the Clarity Act, flooding Senator Tom Tillis' office with calls demanding a total ban on stablecoin yields, and their lobbying pressure has successfully delayed the markup hearing until May. At the exact same moment, U.S. Vice President JD Vance is on the ground in Islamabad, Pakistan, leading second-round negotiations with Iran as the current two-week ceasefire counts down to its Wednesday expiration. Two clocks are ticking simultaneously. The bankers are fighting for their deposits, the diplomats are fighting for a peace deal, and XRP is sitting at $1.42 to $1.44, holding steady through all of it. Stay tuned until the end of this video because I am going to explain exactly why the bank's delay strategy is actually a trap that they have set for themselves and why XRP holders are the ones who are going to benefit from it regardless of how either of these situations resolves. Let us start with the banking lobby attack because the specific mechanics of what the North Carolina Bankers Association is doing and why they are doing it reveals more about the desperation of the traditional banking sector than any earnings report or analyst note ever could. The NCBA coordinating a campaign to flood Senator Tom Tillis' office with calls demanding a stablecoin yield ban is not a policy disagreement, it is a panic response from an industry that has done the math on deposit flight and does not like what the numbers say. Here is the irony that the White House was quick to point out. The actual research on the impact of yield-bearing stablecoins on bank lending shows a projected impact of 0.02%. Not 2%. Not 0.2%. 0.02%. That is the number the banks are organizing a coordinated political campaign over. White House crypto advisor Patrick Witt did not sugarcoat his response. He called the banks greedy and ignorant. And when a sitting administration's crypto advisor uses that language publicly about a banking lobby campaign, it tells you exactly how the White House has calculated the political cost-benefit analysis of this fight. Patrick Witt's specific choice of words, greedy and ignorant, is worth examining for a moment because it is not the language of diplomatic policy disagreement. It is the language of a political advisor who has been authorized to go on offense against a lobbying campaign that the White House has decided it can win both substantively and politically. Greedy because the 0.02% impact number proves that the bank's concern is not about systemic financial stability, it is about protecting a profit center that depends on paying depositors near zero interest while earning market rates on the same capital. Ignorant because the lobbying campaign is built on projections that are not supported by the research they are citing. When the White House goes this publicly aggressive against the banking lobby campaign, they are not just defending the Clarity Act, they are building a political narrative that frames the banks as the obstacle between ordinary Americans and financial innovation that serves them. That narrative is a powerful one in the current political environment, and the banks walk directly into it by launching a campaign that can be dismantled with a single data point. Now let us talk about Islamabad and what JD Vance's presence in Pakistan for second-round Iran negotiations means for the crypto market specifically. Because this is the geopolitical variable that is going to have the most immediate and dramatic impact on price action across the entire digital asset space in the next 72 hours. The current two-week ceasefire between the US and Iran expires this Wednesday, and the second-round negotiations happening in Islamabad right now are the diplomatic mechanism through which either the ceasefire is extended into a formal agreement or it collapses back into active conflict. The DC insider intelligence that is circulating in institutional research circles describes what is being called a grand bargain, a comprehensive deal structure that includes Iran stepping back from nuclear escalation in exchange for sanctions relief, anchored by a U.S. commitment to drive gasoline prices below $2 per gallon before the election cycle through a combination of production agreements and strategic reserve releases. If that deal closes, the $50 billion oil supply shock that has been pressuring global markets reverses rapidly, risk appetite returns across all asset classes, and the crypto market goes parabolic with Bitcoin targeting $100,000 as the leading indicator of the risk-on surge. The scenario in which the Pakistan peace talks fail and the ceasefire expires without a deal is equally important to understand in its full market impact because the downside scenario is not just a short-term volatility event, it is a sustained risk-off environment that would test the support structures that have been holding crypto markets through the current geopolitical uncertainty. If JD Vance's delegation leaves Islamabad without a signed framework agreement before Wednesday's ceasefire expiration, oil markets will immediately price in the resumption of conflict risk, which means oil prices spike, inflation expectations rise, the Federal Reserve's rate cut timeline gets pushed further out, and institutional risk appetite contracts sharply across equities, commodities, and digital assets simultaneously. Bitcoin at $100,000 in the success scenario versus a sharp correction in the failure scenario. That is the binary that the institutional money in this market is currently straddling, which is precisely why XRP is holding at $1.42 to $1.44 with significant volume rather than making directional moves. The smart money is not positioned for one outcome, it is holding at a level that survives both. Here is the specific insight about XRP's positioning relative to the Clarity Act delay that most analysts are completely missing, and this is the part of the story that directly addresses the trap the banks have set for themselves without realizing it. When the North Carolina Bankers Association lobbied successfully to delay the Clarity Act markup until May, they were operating on the assumption that the delay hurts the crypto industry uniformly, that slowing down the legislation slows down the entire digital asset ecosystem equally. That assumption is wrong for one specific asset, and that asset is XRP. Every other major altcoin in the digital asset space depends on the Clarity Act for its regulatory survival. They need the legislation to pass because they do not have legal clarity about their status as commodities rather than securities. XRP already has that clarity. It came from the courts, not from Congress. The Ripple vs. AC case established legal precedent for XRP's regulatory status that exists independently of whether the Clarity Act passes, fails, or gets delayed by 1,000 banking lobby campaigns. XRP does not need the Clarity Act to survive. It was already cleared. The strategic implication of XRP's court-established legal clarity in the context of the Clarity Act delay is significant for a very specific reason that institutional allocators understand and retail investors often miss. When institutional capital is evaluating which digital assets to allocate to during a period of regulatory uncertainty, which is exactly the period the banking lobby is trying to extend by delaying the Clarity Act, the assets with established legal clarity move to the top of the allocation queue. The delay that the banks engineered to slow down the entire crypto sector has inadvertently created a relative advantage for the one asset that does not need the legislation because it already has what the legislation would provide. Every week that the Clarity Act is delayed is another week during which XRP has a court-established legal status advantage over every other major altcoin, and institutional compliance teams allocating in a legally uncertain environment will always prioritize the asset with the clearest legal standing. The banks tried to trap the crypto market. They trapped every asset except the one that was already free. The White House's aggressive public response to the banking lobby campaign is not just a political statement, it is a signal about the legislative strategy the administration is pursuing that has direct implications for the Clarity Act's eventual passage timeline. When the White House publicly calls the banking lobby greedy and ignorant while citing the 0.02% impact number, they are doing two things simultaneously. They are providing political cover for the senators who are being pressured by the banking lobby to oppose stablecoin yield provisions by framing the lobby's position as factually unsupported. The White House is making it easier for those senators to resist the pressure without appearing to be anti-bank. And they are building the public narrative that frames the Clarity Act's passage as a consumer protection issue rather than a crypto industry favor, a framing that makes the legislation more politically durable in an election environment. The delay until May is not a defeat for the Clarity Act. It is a reset that gives the White House time to deploy a stronger political strategy for the final push, and the banking lobby's overreach in citing a 0.02% impact number as grounds for a total ban has handed them the ammunition they need. The technical picture at $1.42 to $1.44 during this period of maximum geopolitical and legislative uncertainty is telling a very specific story about the underlying demand structure for XRP that the price alone does not fully convey. When global markets are pricing in a binary geopolitical outcome, when a banking lobby has successfully delayed major crypto legislation, when the broader altcoin market is under pressure from regulatory uncertainty, and XRP is holding in a tight 2 cents range with significant daily volume, that price stability is not indifference. It is the result of institutional bid support meeting retail uncertainty, selling in a balance that prevents significant downside while the macro variables resolve. The institutions that have built their infrastructure deployment plans around XRP's legal clarity, XRPL's security architecture, and XRP's CBDC interoperability positioning are not going to panic sell because of a banking lobby delay or a ceasefire countdown. They built their positions based on a thesis that extends years beyond this week's headlines, and that long-term conviction is providing the support floor that is holding $1.42 regardless of the short-term noise. The convergence of the Pakistan peace talks and the Clarity Act delay into this specific week creates a market environment where the information advantage belongs entirely to the people who understand both stories at the level of detail we have been discussing. The majority of the market is watching price charts and reacting to headlines without the context to understand that XRP's legal clarity makes the Clarity Act delay irrelevant to its fundamental value, or that the grand bargain structure in Islamabad has specific price implications that flow through oil markets into risk assets into crypto in a predictable sequence. Understanding both of those mechanics in advance of their resolution is the difference between being positioned correctly when the binary resolves and scrambling to react after the move has already happened. The ceasefire expires Wednesday. The markup hearing is pushed to May. XRP is at $1.42. These are not separate facts, they are coordinates on the same map. And the map is pointing in the same direction for XRP, regardless of which specific path the geopolitical situation takes to get there. The complete picture is this. Bankers are panicking over 0.02% and accidentally creating a relative advantage for the one crypto asset that does not need what they are trying to block. Diplomats are in Islamabad negotiating a deal that sends crypto parabolic if it succeeds and creates short-term volatility if it fails, but either way, XRP holds its structural advantage. The White House is publicly dismantling the banking lobby's argument with a single data point and building the political infrastructure for the Clarity Act's final passage push. XRP's court-established legal clarity makes it the safest institutional allocation during any period of regulatory uncertainty, which is the period the banks are trying to extend. And $1.42 to $1.44 with institutional volume support is the market's way of saying that the people who understand what is actually happening are not selling. The ceasefire clock and the legislative calendar are both counting down. When they resolve, the asset that was already legally cleared, already institutionally adopted, and already building quantum-resistant infrastructure is the one that captures the repricing. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.